And we do believe inflation is transitory. I know that's become a bad word recently, but we believe people are going to be shocked at how low inflation goes this year. We're going to see negative year over year in many, many categories.
How has this affected your response to portfolios? Are you doing anything differently?
Well, we're doing right now what we always do during a correction, and this has been an extended one, almost a year now. And we've been concentrating our portfolios towards our highest conviction names. And so we haven't done anything different. And the reason for that is the innovation that we're investing in is following learning curves that are dropping costs and prices and increasing the access to these technologies throughout the world. So they are scaling exponentially, and we just want to be there for the ride.
So there's some concerns that maybe the downside volatility been driven by deterioration in the underlying fundamentals of your holdings.
Well, no. Although those who tag our portfolios with the stay-at-home description would suggest that there's decelerating growth and that it probably will not pick back up. That was a once-in-a-lifetime opportunity, pulled a lot of business ahead. And we think that this year, now that we are getting through the toughest comparisons in terms of the coronavirus, when consumers and businesses were adopting technologies aggressively to solve some big problems they were encountering, now that we're passing through the toughest comparisons, we think this controversy will be put to bed because as we cycle through, we believe their growth rates are going to accelerate. Forces in motion, if we're talking about better, cheaper, faster, more productive, more creative, solving problems, those don't turn back. And so we think that's going to be the big surprise this year. Teladoc is now in our top 5, as is Zoom and Roku. These would fall into the stay-at-home stock category. And we've been increasing our position as we've been concentrating our portfolio. And just to refresh your memory, the reason we concentrate our portfolios is because during risk-off periods, most investors and analysts diversify their portfolios and get closer to their benchmarks, the benchmarks against which they're measured. We do not have any one benchmark. That's not what we do. What we do is buy the stocks that they are selling, because very often in our portfolios, the stocks are either small positions in indexes or they're not in indexes. Our active share relative to NASDAQ or S&P is in the 3 to 6% range. So very few stocks in our portfolios are in the indexes. As investors are selling those shares, again, a decision just to get closer to their benchmark, we're buying them and concentrating our portfolios towards our highest conviction names. So let's talk about Teladoc. And I did write down a few statistics here. Of course, a lot of people introduced to telemedicine during the coronavirus crisis, they got their first taste. And to the extent they can help it, meaning they don't absolutely have to see a doctor for checkup reasons need to be done personally, we are not going back to the old way of doing things. Now, if you look at the revenue of Teladoc, it is up 4-fold from 2019. And perhaps more important, the ARPU, the average revenue per user, has gone from $1, roughly $1, to $2.60. And our analyst, Simon Barnett, says that if they did a lot more cross-selling and just theoretically every person took all of their services, that ARPU could go all the way to 68. Now, of course, it won't, but it is going a lot higher. If I could just give you, in terms of this idea of tough comparisons, I'll give you the most extreme example in the portfolio, Zoom. Just to set Zoom up a little bit, Zoom's user base has gone from 20 million users before the coronavirus to 200 million. Now, many people say, oh, yeah, but a lot of those people aren't paying. Okay, its revenues have gone up sixfold from 2019 to 2021. It is about to face its toughest comparison. Revenue in the fourth quarter a year ago went up 370%. Now, the fear with Zoom is, okay, going back to work, this story is over. Well, it's not over. If their guidance is correct, and they issued it pretty close to the end of the quarter, so I think it's close, their revenue growth in the fourth quarter will be in the 19 to 20% range. Think about that. On top of that, that's against a 68% comparison. Now, that is the toughest quarter they face. The next quarter, they'll be facing 185% growth. Well, we think their revenue growth rate will accelerate. That is when I think a lot of investors will get an aha moment. Wait a minute, what is going on here? Accelerating against this 185% number. And just to give you a sense of their gross margins, 65 to 68. Most of our companies have very nice gross margins. Its valuation today is 8.5 times revenue. Microsoft's, and many people say, I know it's just a microcosm of Microsoft. Microsoft's a much more mature company. Microsoft's price to sales is 10 times. So you can see that many of these emerging growth companies that got an accelerated boost, a tailwind from the COVID crisis, are now selling at lower multiples on that basis than the most mature companies in the marketplace. And what most people do not understand when it comes to Zoom in particular, communications, that category, is the largest part of the technology, the enterprise technology stack. So telecommunications globally is a $1.5 trillion business. Zoom's revenue base is $4 billion. Again, a real company. Now, we believe that we are in the first major, you'd call it rip and replace, except this is digital, first major rip and replace cycle for the communications part of the tech stack since the early 90s. This is a $1.5 trillion category. Zoom is starting to replace PBXs. So the Ciscos and the Polycoms out there, we believe, are going to be pushed out. So this is a much bigger story than just video communications, although we do believe that is a very valuable piece of the story.
So, Cathie, let's switch gears for a second. You touched a little bit on Teladoc. Healthcare and genomics names were hit particularly hard in the last 12 months. Talk about that space, and are you still excited about it?
We couldn't be more excited. You know, the space went into a little bit more of a tailspin this week after the JP Morgan conference. And the purported reason for that was, we didn't get any real M&A out of this. This is usually when big announcements are made, and typically there are a few very good M&A events. So what we're dealing here with is really the longest duration stocks in our portfolio. And if you've been watching, we are continuing to add to these names every time they come down. Now, many of these names, again, you've got algorithms at work, and you've got an inflation fear out there, which many people think means higher interest rates. And interestingly, long-term interest rates are not confirming that, by the way. And we do believe inflation is transitory. I know that's become a bad word recently, but we believe people are going to be shocked at how low inflation goes this year. We're going to see negative year over year in many, many categories. Today's retail sales report proves that out. So we're dealing with that issue. Inflation, interest rates go up, lowering the present value of future cash flows. And of course, we're looking way into the future with some genomics names. What's going on in healthcare is increasing confidence that we are going to be able to cure disease. And Intelia, for example, did something this year, it was a few months ago, that nobody thought was possible. Its results from an in vivo trial, which means it was delivered internally, not externally to T cells that have been pulled out of the body. So it's like real medicine. That the cure rate in a rare disease called HATTR was the same in humans as it was in primates. And that was a very high cure rate. I think it was in the 80s. Don't quote me on that, but it was very high, shockingly high. So this is telling us that, first of all, identifying mutations, which we do through DNA sequencing, and figuring out what genes to edit to reprogram the genome and get rid of the programming error or the mutation, that this is going to cure disease. Now, it's very interesting, and I may have said this to you before, it's very interesting to have watched Apple scale to a $3 trillion market cap. But the 4 or 5 companies now that have the best patent positions in CRISPR, Cas9, and in base editing and prime editing, those caps collectively don't even amount to $50 billion. And we're talking about curing diseases. They have the patents. They will be getting royalties from everyone. And that's just one small microcosm of what's going to happen in this genomic revolution. It is the convergence of DNA sequencing, artificial intelligence, gene therapies like gene editing, and the way the genome stocks have been treated is purely for a macro reason. Anyone looking at the micros would not be selling these stocks.